A full-year guidance raise. The world's biggest lodging REIT saw nearly 8% growth in its funds from operations from the previous year. They're also the largest third-party owner of Marriott and Hyatt hotels, with 72 properties in the U.S. and 5 more internationally. Here for an exclusive interview is Jim Risoleo. He is the CEO. Jim, it's good to have you here. Welcome.
Kelly, thanks for having me.
This flies in the face a little bit of what we've heard. We've had companies lowering guidance. We sometimes hear the high-end consumer is hard hit, or even the Target CEO today said people are even pulling back on groceries. Maybe that's not your core customer, but what are you seeing?
Well, we're very optimistic about the state of travel. We had a terrific quarter, as you just pointed out, and we're able to hold our guidance for the full year. We're optimistic on a lot of different fronts because we continue to see strength and improvement in our group business. It's very strong. We're seeing the gradual evolution of the return of the business traveler over on a month-by-month basis. Our leisure rates, our leisure customer, we have 16 resorts. Leisure rates are still up 56% compared to 2019 in the third quarter. So we're not really seeing a meaningful pullback by any means on the leisure. International inbound's another tailwind for us as we start to see the international business recover. That's going to help us as well. Yeah. And consumers are they're just still prioritizing experiences over goods. We see it in our out-of-room spend in our hotels, both in the resort properties as well as our urban properties. Our food and beverage numbers are above where they were in 2022 and 2019. So we're optimistic on a lot of fronts.
That's interesting, and it jibes a little bit with what we heard from Charlie Babrinskoy earlier on, who said, the fact that the Sphere in Las Vegas has done so well is making him bullish on a lot of other parts of this space. Right. So you mentioned group, and I don't know if the Marriott Marquis, just one well-known example around here, if that's a big part of revenue or EBITDA or anything like that. But when you say that group is kind of coming back and driving some of these results, just talk in some detail about what you're seeing there.
Sure. In the third quarter, we booked 245,000 group room nights in the quarter for the quarter. And that revenue pace for 2023 is almost 7% greater than where it was at this point in time in 2019. A differentiator for us in many ways is the quality of our assets. And we have invested meaningfully in our properties over the course of the pandemic. We've invested $1.5 billion in our hotels, in addition to acquiring 8 new properties at a cost of $1.8 billion. So Marriott Marquis is a good example. We did a complete transformational renovation of that asset over the course of the pandemic. And we have seen a meaningful pickup in group business and transient business at that property. In fact, I talked about this on the call today. 3 markets that are very important to us from a business transient perspective, New York, San Francisco, and Denver, are only down 10% in business transient room nights relative to where we were in 2019. So, we have a fortress balance sheet, Kelly, that allows us to pull levers on all fronts. We're the only investment grade lodging REIT. And in addition to, continuing to invest in our assets and acquiring hotels, in the quarter, we bought back stock. We raised our dividend. So we're very well positioned for any macroeconomic environment that may come our way.